Good morning, everyone. Thank you so much for attending today's session. Sorry, I am a little bit late today. Just got off a client call, so was in a bit of a rush to get back here. My apologies. So Justin Ishac, Senior Investment Manager here at Sharewise. I'll get right into it. We won't waste any time today. I'm also going to just quickly get started with the disclaimers. So first of all of the information provided to you today is all general advice. Please take into account the risks when you're looking at investing in the markets, and obviously assess that for yourself as well, and understand that this is all general advice and informational purposes only on this webinar today. So we will be discussing some interesting topics today. Recently we've seen the headlines around a recession. There's been a lot of really good questions. I've had some attendees ask me a couple of questions. Some of the registrants here today, also some clients, which is really good to see. Thank you so much for the questions. One of them, Rob and David. So I'll be mentioning your questions today. I think they're both very relevant, and we'll go from there. All right, so let's get started. So today's going to be a little different, ladies and gentlemen. We're not going to be doing a presentation. I'm actually going to take you through a walkthrough of the market. I'm going to lead you through some important data points, and we're going to be discussing the general view of the market and a few key facts that I think are vital for your decision-making process before you invest. Okay, at the end of the webinar as well, if you guys please can just complete the poll, that'll be great. At the end of the day, I think that's going to be very important for you guys to really consider a strategy session. And, in that poll, you'll get some very good questions and ideas on what you need as an investor as well. Okay, so let's get started. First thing, I'm going to just share my screen. Bear with me. Lovely. Okay, so you guys should be able to see that now. Fantastic. And I'm going to turn my face off. Lovely. Okay. So just let me know if you can or can't see the screen there, please, in the questionnaire section. But you should be able to view my screen. Okay. So this is the S&P 500, right? So thank you, Paul. Beautiful. So the S&P 500 today, obviously in the last, let's have a look here, since we go back to this time frame. So from approximately the 19th of February to today, we're looking at approximately give or take a 10% correction on the S&P. All right. So, ladies and gentlemen, obviously we've seen quite a bit of a correction, and a lot of that there is no doubt is related to the president, obviously Donald Trump's tariffs. Okay. So I'm going to be talking about that. We're going to be talking about what to do. We're going to be talking about the upcoming data points and everything else. Okay. So look, I just wanted to mention a few key points and take you through a few concepts that a lot of investors don't quite know, that I think is really interesting. So there are seasonal patterns known as calendar effects that can influence stock market. Okay, so the notable patterns include what's usually called sell in May and go away. Okay, this is a strategy based on the observation that the period from November to April often yields stronger stock market growth compared to May to October, right? And that's usually toward the end of May, that is. You usually get a good run during May as well, though. And this study that was done by Berman and Jacobson in 2002. Now, they found that this effect occurred in 36 out of 37 countries examined, with the effect being particularly strong in European markets, okay? But obviously still weighted to the US. Now, what that means is, you've got seasons and months that usually are quite bullish for markets, and it's quite normal, right? It's quite normal. It doesn't mean we're going into a bear market right away, okay? So that's something I really wanted to address. But also there's, the phenomenon of Santa Claus rallies where you get a good run during the Christmas period. But understanding these patterns can really help differentiate between a typical seasonal fluctuation and more significant market corrections, okay? Now, I know this is a little bit different. Obviously, we've got a lot of trade policies in place, and we're going to go through all that. But the point I'm trying to make here is you just want to be mindful that it's not all doom and gloom just because you've seen a rough 2 or 3 weeks, right? It can be. We could see more pain, but it just depends. And I'm going to go through that, right? So Trump's tariffs plan, obviously, this has been a leading reason for the market to correct itself, I would say, right? Some have mentioned that it could be an artificial or an engineered pullback, which could be the case. But at the same time, I would also argue that sometimes pullbacks are necessary and they're healthy. They help investors buy the dip at the right, to dollar cost average. And if you can do it at the right time, you can optimize your returns as well. At the end of the day, without volatility, you're not going to optimize your returns. That's it. It's simple as that. If the market just keeps on going slow and steady, it's never going to give you anything. You're going to be slowly just watching things move. And I'm going to give you some really interesting facts from a few other fund managers out of the US, very well-known fund managers like Tom Lee. If any of you have heard of Tom Lee, he's recently discussed the best 10 days of the market in 24, I believe it was. And we'll go through that as well. And I'm going to also take you through, as I said, some of the tariffs and everything else. But firstly, the recent developments in US trade policy have significantly impacted the US market. As you can see, the S&P is down from where it was in just over 6,000 points to 5,500 roughly, or just over. If you have a look at the NASDAQ composite, we're down at about in this area. So we've broken some significant support around here, and we're trading in and around this level at the moment. Okay, so it's obvious that we're seeing some significant levels of support being tested at the moment as a market. Now, in March 2025, recently, in the beginning of the month, the President Trump basically announced a 25% tariff on all imports from Canada and Mexico, citing concerns over illegal immigration and drug trafficking, amongst other things. So the announcement led to considerable drops in the US markets, and global markets have been impacted, mainly US, bit of the Aussie market as well. So we've seen the S&P falling by, anywhere between 1.5 to 2% a day in some areas, and obviously the NASDAQ anywhere between 1.5 to over 2% per day as well, or just over. So the escalation and retaliation following the initial tariffs, really is that the US imposed additional tariffs on Chinese goods, increasing from 10% to 20%, which is in response to China, announced plans to implement its own tariffs on 128 US products, further escalating trade tensions during this period. So we've seen these issues really weigh in on markets at the moment, and these actions have contributed to increased market volatility, as we've seen over time, okay, in the last few weeks, particularly. Now, what's the Fed's move? So I guess from here, the real question is, well, what do we do? What's going on? Is this a bottom? Is this the time to sell? Is it going lower? Or is it time to buy? A lot of questions are asked. A lot of clients are asking these questions. A lot of people in general are wondering what to do. Now, what's important, I think, to really take away from this is that we have seen already quite a bit of a consolidation, right? Now, this gray line here is the 200-day moving average, okay? So this is just a trend line that I've drawn. You can see it's respected this trend line in a bullish market over the time when you look at this. But we've just broken that 200-day moving average, which is not good. But if we can hold up here, we do also think that this could be an opportunity to create some significant wealth in the next few months, okay? I'm going to take you through the reasons for that. Now, just going back to the Fed monetary policy and what to expect and where to position yourself. So if we have a look at some of the data points coming out, right? So at the moment, we actually have some of the most important monthly data points to be released. Now, this is going to be the catalyst for further downside or potentially a significant uptick. All right. Now, anybody that tells you that they definitely know what's going to happen, I'd be careful of, right? But what I will say is, I do think there is a better story to be told as opposed to being overly concerned and negative at the moment, right? However, data points to be considered that really need to be taken into account before making any major changes to your portfolio is CPI month on month to be released in the US. So obviously this will be available to us, or it will be reported for us tomorrow morning. We'll know around in the morning, just after the close of the market, roughly. So obviously the CPI month-on-month expectation or forecast is 0.3%, right? So what that comes in as is going to be very important. That's going to be a key data point to give us an indication on what the Fed may do, and I'll explain why year on year as well, right? So the forecast is 2.9%. Obviously, if it comes in line with expectations, that could be a positive for markets as well, right? Then we've got PPI. That's another really important one. A lot of people overlook that. So PPI month on month is very important. So this obviously measures in the price of finished goods and services sold by producers, excluding food and energy, right? So if actual is greater than forecast, it's good for currency, which can have an impact on markets as well. And I'll go into that too. And then you've obviously got as well the month-on-month data and unemployment claims. So this is all very important, okay? These next 2 days, if not the 24 hours coming, is going to be so important for us as a market. It's not funny. Right? Now, there are two different stories here. One is if the inflation or CPI data that gets reported tomorrow comes in line with expectations, I think you could see a significant run in the market. Okay? I think you could see a significant bounce back come through, right? Now, obviously, that doesn't mean go and buy it all today. I'm not saying that. Remember, this is general advice and general market views, but I'd be sort of more inclined to believe that a lot of the negativity is potentially priced in, but it does depend on these data points to be released and the FOMC statement to be released next Thursday as well. Okay, so keep that in mind. So the FOMC statement is obviously going to be the more important commentary we're waiting on from Jerome Powell, right? So this is where he'll basically address the nation in terms of their federal funds rate, economic projections, and the statement itself. And the rhetoric from the statement is going to really give us a clear indication on where the market could go and what their decision will be relating to monetary policy. So if CPI comes in line with expectations, that could be very bullish for markets. We could see the market really bounce back here. Okay. If we see, let's just say, inflation coming hotter than expected, we could see a bit more volatility as well. Now, if CPI comes in lower than expected, right, and the rhetoric from the Federal Reserve is a bit more concerning, and they take a decision to reduce interest rates significantly with the rhetoric of a negative economic concern, right, or recessionary fears, you could see the market sell off more, right, as well. But at the same time, you could also see, I know that sounds contradictory, but it's just the way it is, right? You could also see after that fact a very sharp bounce back once rates are reduced as well, because obviously they're allowing more liquidity into the market and they're producing an opportunity for an influx of quantitative easing to allow a softer push on the economy, and the market could start to rally again as well, right? So I don't think it's the end of the world. I think either way, there will be a significant buying opportunity amongst us. And I'm just going to lead back into some key stats that I think are very important to note as well when looking at this type of market movement. Okay, so historically speaking, there's been many corrections, and I'm going to show you right now on a chart as well what I mean, right? So investors, I mean, first of all, deciding whether to invest during market downturns does require a lot of analysis, because in times like these, you can get further drops, which can obviously be almost as though you're catching a falling knife, right? However, during these times, it's important to understand that the S&P, the NASDAQ, and the US equity markets have all gone through annual corrections semi-annual corrections, 2-year corrections, 5-year corrections. Now, historically, right? Now, historical movements aren't always an indication of future movements, but at the same time, they are a significant indication on what usually does happen, right? So, you know, if we look at the annual sort of corrections, historically, the S&P experiences a correction of about 10% or more, approximately once every 1.8 years. So let's call it 2 years, right? Now, that equals, you know, roughly over a 100-year period, about 50 rough corrections, 54 corrections, okay? And our bear markets since 1929, there have been 29 cyclical bear markets in the S&P with an average duration of about 382 days and an average loss of about 21%. Are we there? No one really knows, right? But the point here is, I think it's fair to say we're more around the correction territory of that 10% to 14% if we see inflation come in line with expectations. Now, the average percentage drops over specific intervals. So every 2 years, while the market doesn't adhere to strict schedule, okay, on average, it still corrects about 10 to 14% every 2 years, okay? So if we look at it right now, if we pull up the S&P, right, we've already seen at the moment, as I already showed you, give or take, roughly 10%, okay? Before that, if we go back to July of 24, which was almost a year ago, we saw a pullback of, what's that, 8%, right? We go all the way back to September. Well, I mean, you could say about, what, 6 months worth of downside movement, or 4 months, back in the period of July 23 till roughly October, 26th of October 23, that was about an 11% correction as well, right? So we've already seen quite a sharp correction, really sharp correction. Every time we get in and around that 200-day moving average, we start to get a significant recovery. Now, obviously, it just depends on what happens in the next few days with these data points and the FOMC statement that I have already mentioned, all right? Now, if we go back to COVID, obviously, that's a bit different, right? We saw a really sharp drop during COVID. That's clearly showing what? So if we go back to this period, sorry, guys. Look at this. So we saw, and this is nothing like COVID. We're not shutting down towns and industries and centers, and people are not going to work. It's not happening. You know, people are working. Everybody's up and about. There's no pandemic issues, nothing like that at all, right? But if you look at this, we had a 36% correction within the space of about, what, 3 weeks, right? That is huge. That is huge. So, you know, and then we got a very sharp recovery. We're not in that phase, okay? But it's just important to note that we've already corrected significantly. So given that we're not in a pandemic and we've already had some significant correction percentage movements take place, I would argue that there's an opportunity here we might want to really consider as a buy, unless we've got obviously recessionary fears really on the cards. And at the moment, that's not exactly what we know, right? We don't know for sure that we're in a recession. Yes, jobs data didn't come in line previously with what we wanted to see. Yes, we've seen the tariffs have a massive impact. Yes, they can be inflationary, but at the same time, I still think this is overblowing what the data is that we already have, right? So we just want to keep our eye on what's happening over the next couple of days with those data points before we make a very big decision on selling everything or not, right? So timing and patience is important. Given that corrections of 10% or more occur roughly every 2 years, you know, investors, you should be prepared for these downturns and have a strategy in place. And here at Sharewise, we can help you manage the downside. We've been in some positions that are down, okay? Some stocks have pulled back, unfortunately, this time around. It is what it is. But at the same time, we've also got a strategy in place to get out of the red, right? And we've also got some positions that aren't doing too bad either, like some oil and gas names, right? Some gold names as well. And what we want to do here is it's essential to recognize that not all corrections lead to bear markets, and that the market often rebounds over time anyway. So you just want to exercise some patience before you make some very rash decisions as well. So while buying the dip can be profitable, it's vital to assess the underlying cause of the market correction. And that's why I wanted to share with you these data points around CPI, the FOMC statement, unemployment claims that are coming out as well, right? Diversification, maintaining a diversified portfolio can help you mitigate those risks. And this is associated to those market corrections. So we get some, as I mentioned in previous webinars, there are some cyclical trades you could do, some defensive areas you could rotate into to protect you, pay you a good dividend until you're ready to take action on some high beta and alpha plays as well. And we can talk about that in a strategy session as well. All right, guys. Now I'm just going to lead into some of the comments that have been mentioned here from Tom Lee. If you're not familiar with Tom Lee, he's a very well-known fund manager out in the US who discusses a lot of his strategy online. The fund he runs is FundStrat. I love his rhetoric, and I think he's usually quite right. And he's been spot on, and he's quite he's been quite spot on, particularly with the Nasdaq and the US markets lately. The last 24 months, I think his fund returned some significant returns. And so I think it's important to note fund managers like this who are contrarian to a lot of the negative naysayers out there as well. And that's something to really be mindful of, right? So Tom Lee from FundStrat, he's emphasized that a small number of trading days account for the major or majority of market returns after significant corrections, right? So he's suggesting, his research suggests that there are 10 most bullish days in a given year that contribute significantly to total annual gains in the S&P 500, right? Now, missing those days could drastically reduce portfolio performance, okay? So in other words, there are common analogies, common statements like the blood on the streets is what you want to be buying, right? The market pulls back, you buy. Things like that. They're all common knowledge terms that are used, but they can be so right if done at the right time. And this could be, I'm not saying that the market's bottomed here. You know, you could still get a bit of a bottoming, right? But at the end of the day, I would argue that this is probably a better time in terms of market correction to be buying than where the S&P was at 6,000 points, right? But you just want to be mindful of the data coming out. Now, the key insights on this best 10 days, quote unquote, market phenomenon are the following. So you've got the market gains are concentrated. So historically, about 90% of the stock market's annual returns come from anywhere between 8 to 14 trading days. Now, these bullish days are often clustered around major market rebounds, surprises in economic data, or policy shifts. Now, we've got some key data points coming out. Policy shifts already had, and already approximately a 10 to 14% correction already had in the S&P and the Nasdaq at the moment already. So timing is difficult, but this could be an optimal time to really be buying into this correction. So many investors try to time the market and then miss these key days. And it's a fact that, for example, the 21% return that we saw in 24 in the market accounted by roughly 12 of those days of the year, okay? And the remaining 4, 5, 6% came about throughout the rest of the year. So that's really interesting. What that means is during a market correction is the time where you should be really starting to focus on where to put money. And that's what we're here to talk about at Sharewise. We've got a lot of options, a lot of outperforming positions that have been significantly sold off recently that we're going to take a look at that I've already discussed in my previous webinars, okay? So recently, obviously, if you take a look at Tesla in the last few webinars, I have mentioned that we've been eyeing this out for a while and that we want to really consider looking at this as a potential buy, right? Now, you can see in the previous webinar, I mentioned that we might test the 200-day moving average. So as you can see, this is the 200-day moving average. that we've tested already. And we've actually significantly sold off, right? So we're trading at $230 a share US. So this could be an optimal zone to be allocating capital to. Now, I'm not saying go and run in and buy it all right now, right? What I'm saying is this could be an opportunity that you've been waiting on if you missed the boat on Tesla last year, okay? So we could be watching this. Now, if you want perfect timing and if you want some entry points to consider and to discuss a strategy session around some of these oversold positions that we could be buying, give me a call, leave your details, answer on the poll. I'd be happy to help you guys, all right? So in short, we could be entering a very nice opportunity here on Tesla, okay? Another one that I mentioned was Palantir, which we took a lot of profit on. Now look at that, we've reached the golden zone on the Fibonacci retracement, and we're in a strong support zone at the moment as well, right? Now this could still see some correction. I don't know if this is the bottom yet, but I did mention that people could take profits in and around this area in a couple of webinars, and that we'd be looking at buying it back. So right now, we're still eyeing this out, but this could be a significant opportunity as well. So, just had a question come through here from Paul, one of our clients, I believe, and also an attendee. He's mentioned, I think a lot of Yanks are not happy with Musk or his company. So, yeah, look, that's a fair comment, Paul, but at the same time, I think it's fair to say that there could be a significant buying opportunity here as well, right? So the reality is, could still be a bit of downside risk, but we'd be really looking at this as a potential buy at some point, right? So Palantir, as I was saying, we'd be looking at this as a potential buy, okay? Anytime in the next, I would say, well, we're gonna watch this carefully. I'm not going to put a time frame on it, but we're going to watch it very carefully, okay? Obviously, if we take a look at some others recently, some MicroStrategy, I've traded in and out of this, but at the moment we're watching this as well. Nvidia will just come off a little bit here as well. We're watching this very carefully. Yes, it's come back. It's moved back up to 143. It's been moving in and around. It's been quite volatile, but we still think this is still a good opportunity for the longer term. At the moment, ExxonMobil as well is another one, that you could also be looking at. Still doesn't look too bad. It's tested that 112 level, got rejected. So it's going to be interesting to see what happens over here in the next couple of days. But we still do like ExxonMobil. And again, just to cover the S&P, I think and I've just already marked this out already for you guys as well. We've got a few corrections that have already taken place on the S&P over the last couple of years. And we just had one recently, and we do think this could be a significant opportunity to be buying. However, we want to see how the next 24 to 48 hours pan out, and we would be adequately eyeing out this 5,800 range, but we want to see it take over, okay? And so that's one thing we'd be keeping an eye on those futures. If you look at the current S&P pricing right now, 5,500, we really want to see it come back up to that 57 level or 5,800 level and get taken out for a conviction sort of trade. Obviously, within that movement, you could get, you could miss about 5, 10, 20% in some positions, depending on the stocks you're looking at. But it's fair to say that it's still something to be eyeing out before taking too much of a dive. And at the same time, if you want to time some of the positions before that conviction trade, if you want to work with me on the advisor side, I'd be happy to look at some opportunities with you as well. All right. Now, ladies and gentlemen, I've been asked a couple of questions recently, one of which was from a client mine, Rob. It has been reported the US heading into recession. Should invest in the US market continue or not? Good question. I think I've already answered that pretty much, Rob. We'd still be looking at the US. We'd still be looking at allocating some capital into some quality names, but we'd be very mindful of what we're doing and our timing. And obviously, I think I've already mentioned that throughout the majority of this webinar. Now, the next one on bonds was from David. So he's mentioned thoughts on bonds or bond ETFs, right? So look, really good question, David. At the moment, look, we're not really looking at bonds as a strategy per se, but it's important to look at bonds as it relates to equity markets. And I'm going to actually show you at the moment, right? So I'm just trying to pull this up for you guys. Here we go. So let's look at the 10-year Treasury note, right? So it's important to note that as the US 10-year Treasury sort of pulls back, you get a bit of positive movement in equity markets as well, okay? So, you know, some would argue that if you get a massive run in the bond, in the 10-year bond yield, you could get obviously a bit of a pullback. But for the moment, we wouldn't be buying bonds specifically. We'd be focused on looking at some, I would say, diversified US stock positions really would be the priority. Look, the main thing to take away before sort of taking a bond strategy would be firstly the market environment. Okay, David. So essentially, the Fed is still in a keeping the rate as is for longer sort of stance, but markets are pricing in potential rate cuts later on in 2025. Now, if rates fall, bond prices will rise, benefiting bond ETFs potentially. Okay, so inflation remains sort of sticky. Bond yields may stay elevated, limiting price appreciation. However, obviously, Treasury inflation protected securities can hedge against inflation as well. Now, again, if inflation comes along with expectations, I would rather look at equity markets as opposed to bond, right? So that's what we would sort of say as a potential strategy. If rate cuts happen later this year, you know, long duration bond ETFs could be or see solid gains, right? If inflation remains sticky, short-term and floating rate bonds might be better as well, right? So I hope that answers your question, David. But again, if you want more sort of insight on this, I'd be happy to take you through that as well. I do need to keep it sort of timely. Got a lot of clients to call back today. And I think we'll leave it at there, ladies and gentlemen. But before I sort of let you go, I will just also launch a poll, okay? For those that have attended, please answer the poll. And I think you'll get a lot of insights out of this. I did get a question as well, actually, that's just come through, and that is, would you see AI as still a play at the moment? A really good question. So we do still see AI as a potential play. And again, I think the main takeaway from this webinar is it is dependent upon the US data that is released in the next few days and the next week relating to the interest rate decisions as well. So we would say keep an eye on inflation, keep an eye on interest rate decisions, and if they come in line with what's expected in terms of CPI, we would argue you could look at maybe a high beta play and you could look at some AI trades. And again, we could discuss this with you with a lot more detail here at Sharewise. I'd be happy to discuss that with you as your investment manager. If you'd like to discuss this in more detail, we can definitely take you through that. Another one I wanted to also mention was I've been asked a little bit about gold recently. So some clients have asked some questions about gold. So I sort of share my screen and go through that as well. So recently we've seen gold prices trade in and around this level, right? So the question essentially was, what do you think about gold? Would you be a buyer here of gold miners? And the answer to that is ultimately we still are quite long-term on gold as a buyer, right? But you know, I think a real key indication of where gold could go will be reliant upon the US dollar as well. So you want to be mindful of that. Currency fluctuations can still impact the price movement of gold, as it is an inverse sort of correlation. It hasn't been too inverse, right? We've still seen the US dollar, you know, since November last year remain a little elevated, and basically gold has still moved higher, right? So what that means is we would be still monitoring the US dollar, and that's going to be, I would say, mainly affected by the interest rate decision. right? So whatever the interest rate decision is in the near term will be a catalyst to the upside in the US dollar or downside in the US dollar, and that'll play an impact on gold. But in general, we are of the view that gold prices could go higher. We're at a significant resistance level right now, okay, on gold, and it's been quite heavily supported recently around that 2,900 level, right? So anywhere between 28.89 and 28.79, we've seen some significant support. And if you remember from my previous swing trading webinars, I also mentioned higher highs and higher lows, right? So if you do take a look at this, we have recently seen higher low recently around this level, and then a lower high. So this is a bit interesting, but then a higher low again here. Now a lower high. So I think we're getting a bit of consolidation before we potentially break out in and around that $3,000 US, $3,000 per US ounce level, right? So we would be monitoring that at the moment before taking a buy on any large gold producers. But at the same time, we do think ultimately there could be some significant upside still for gold. All right. I hope that answers your question, ladies and gentlemen. Thank you so much. Please answer that poll. I think pretty much we're all done here. Again, if you do want to work with me on the advisor side, I'd love to sort of call you. We can go through a strategy session, portfolio review, and any questions, again, I'd be happy to take on that phone call as well. Thank you so much for your time. I'm going to end the poll now, and I hope to speak with you all shortly, and we'll speak soon. Thank you very much.